Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Oh, welcome back. Sure is cold out there. Oh, wow. A lot of stuff going on around the world, actually, with 7 billion people in it. You'd kind of figure that there would be a lot of stuff going on. So, a lot of economic stuff. They keep threatening to raise interest rates and at some point in time. And actually, just threatening is pretty effective, because the bond rates were significantly lower, a little over a year ago than they are today. So just the threat of raising interest rates has some people selling long-term bonds. And when they sell the long-term bonds, the price goes down and the yield goes up. So we had a 10-year yield that was substantially lower than it is today, 10-year treasuries, that is. But the 10-year, they're still not paying very much. And in fact, I'm waiting for my computer to come up so I can tell you what they are. But so as soon as that happens, we'll do that. And a little later in today's show, I think I'm supposed to have a call in. I hope he's going to call in. I got an enrolled agent that's a tax expert, and just thought we would go over a little bit how the IRA distributions, mandatory distributions, required minimum distributions are. If you had a 401k or if you have an IRA, when you reach 72 now, they've extended that, you have to start taking some money out of it. And I thought would go through that a little bit, and anything else he wanted to talk about. His name is Bob Klingman, by the way, and I refer an awful lot of people to him. He is an enrolled agent, so passed all those tests, has to pay for all that software, has done a very good job for a lot of my clients, so been very happy over the years. And we'll be talking about that. If you have a question or call that you would like to ask, I am in the studio live today. So you can call 216-901-0945. That's 216-901-0945 and ask away. Anything to do with investing or personal finance. And if I don't know the answer, normally, and this is what I do, one of the reasons that we at Bullington Capital are still here, still in business, we have a question we don't know the answer to, we'll find someone that does. We have a fairly large network after all these years. And it's been interesting for me. I get questions all the time, and things are changing all the time. Actually, I think I read somewhere where the Internal Revenue Code changes about 15% of it each year, which means that after about 4 to 5 years, the entire thing's been rewritten. That is amazing, because there are more than 10,000 pages in the Internal Revenue Code. So, but yeah. So if you have questions, calls, feel free to reach out to us. You can go to my website, bullingtoncapital.com. There, hopefully, we'll start to get some seminars going again at some point in time. And we are moving our office. It's right across the street, actually. The buildings are all owned by one company. And somebody wanted to move into our space, and our lease was up. So we're moving into a space in one of the other buildings right across the street. I really like it. That's kind of exciting. But we'll be doing that sometime in March. So here is the current yield on the 10 years, actually 1.93. So it's 1.913. So it's almost 2%. And that's actually a lot higher than I thought it would be at this point in time. And that's what you get for thinking. I'm just kidding, kind of. But if you've got, now my computer's going wonky on me. Have you noticed that the last few days, a lot of technology has not been performing like it's supposed to? We have computer-based phones, and people were calling and saying, "Hey, this is not getting. We're not getting through." And then I called, and it was working again, and that's been known to happen. And I'm pretty sure it's because the weather, and so many people are, that. Let me tell you something. That's the big scare for me with the going to the driverless cars. I know how many times I see flaws in software in financial markets. And, financial markets are pretty important. So you see accidents happening in that field, and you just know that in your cars. Anyway, I won't go there. It's a little spooky, but and that's just the way it is. It's just kind of the way it is today. There are no cars out there without computers in them anymore. So just be careful. Let's see. I was trying to pull up the longer term rates on bonds, but it's just not coming up here today. Anyway, so I guess I'll just talk a little bit about the stock market and what we're seeing. And market pulled back here a couple weeks ago, was down fairly significantly month of January. From top to bottom, it was down over 10%. So that's large enough to be considered a correction. And then it bounced a little bit through the middle of last week. Then it came back, dropped down a little bit more. You can't really predict off that. And that is one of the things I've been wanting to talk about is, people predict, they try to predict, and a lot of people can't invest unless they have an expectation of what's going to happen. If your expectations are, long enough out, like let's say you're looking out over the next 10 years, and that's the minimum that I would look at these days. If you're looking at the next 10 years and how you should be investing for the next 10 years, even if you're taking out income, okay, then you should be okay, and you really shouldn't be paying too much attention to the gyrations in the market. That will drive you crazy. So you want to make sure that you're diversified. That's incredibly important. I can't tell you how many people I've talked to over the years who had an enormous amount of money put into one stock, and when that stock crashed, it just ruined their retirement. And I've seen it so often now that I just can't do it. I can't recommend that you hold a single solitary company. And I've been in the business long enough now to remember all the companies that couldn't go wrong that are selling at about 80% of where they sold 20 years ago. And these are companies that couldn't go wrong. There are enormous numbers of those stocks. GE. Take a look at GE. GE could not go wrong here in the greater Cleveland area. They were a huge employer. GE's top price. And now people look at it and go, well, it's not GE. That's because you weren't old enough, knucklehead. You weren't old enough to be around there. And you look at the chart on GE, and I'm telling you, you could not talk people out of GE. And it's ruined some people's lives financially, just ruined them. And you look at, this reminds me of, Apple at one point in time, it's going to go down, and it's going to go down a lot. It's near its all-time highs right now, so that makes it really difficult for people to think about it. But you have to think about what Apple does. Apple makes technology, and the only thing more fickle than technology are teenagers who drive a lot of this technology buys, by the way. So one generation, who would have thought that, Facebook, now it's called Meta for some reason. Yeah, who would have thought that they would start losing in popularity? Anybody old enough to remember a company called MySpace? Okay, that was the pre-Facebook Facebook. And when Facebook, it's one of the reasons Facebook is in a couple of the funds that I own, but it's a very small percentage. It's in there, still in there. So it's a super small percentage. So when it was dropping like a rock, I'm not really that worried about it. That's one of the big benefits of having a truly diversified portfolio. And, I don't have to worry about it. I don't have to worry about much of any stocks. In fact, one of the stocks that I own that I like a lot individually, because I still have some of the money in there, is just been taking a whooping. And I look at that and I go, yeah, that's par for the course. It's par for the course to be. I'll never forget. You're reading in one of Peter Lynch's books, and this is way back. In fact, the young people should probably go back and get those books. Just go to Google Peter Lynch, and buy his books and read them, because he tells it like it is. He was an analyst. He's working at Fidelity Investments. And this Peter Lynch, by the way, has got the best track record of one of the best track records of any portfolio manager that's ever lived. And when he was managing money professionally, he beat Warren Buffett. Think about that for a second. Okay, so this guy probably knows a thing or two. And he was reminiscing over the time that he was an analyst. It's before they gave him money to manage. And said he was pounding the table that Taco Bell could not go below $9 a share right before it went to $1. The two things that impressed me about that: first of all, he was making a joke about it. Secondly, that he was honest enough to talk about it. And I was so thankful for that, especially at that point in my career. I'd only been in the business like 2-3 years when he wrote that book, maybe 4, I don't know. But you hear all these stories and can't miss. Oh, no. Anything can miss. Anything can miss. And that's why it's so important, especially right now. When you look at where the valuations on stocks are, they're not cheap. They're cheap. They're probably, they're right around where they should be if interest rates stay this low. If interest rates stay this low, now they keep talking about raising rates, then they're okay. But if interest rates start to go up, you get a 4 or 5% CD, and that big sucking sound you're hearing across the world is money coming out of the stock market and going back into CDs and short-term government bonds. And that could be very hazardous for your financial health if you are approaching retirement, or if you don't have a real strong personality that can weather the storm. Because you get a 4 or 5% CD, there are going to be an awful lot of people buying CDs, and they'll be taking money from stocks. So not sure if that's actually going to happen, because I'm sure the Fed is already aware that would happen. And I also know that when they start raising interest rates, some people who may have qualified for loans will not qualify anymore. That'll slow down the economy. In addition to that, you're going to have interest on the national debt that's going up. And for every 1%, I don't know, it's $30 or $40 billion in interest, extra interest, somewhere around there. I'll have to go fact check that, but I know it's in the tens of billions. And that's not a one-time, just this 1 year. That's an ongoing thing. So I'm not sure if they're going to go up a lot, but I do know that with higher inflation, the kind of inflation that we've seen now, they're going to be raising it. They're going to be raising it somewhat, and the market has not waited for for the Fed to start raising. They've been selling off bonds. When you sell a bond, and you sell lots of bonds, pretty quickly, the prices tend to drop because people are crowding. You're trying to crowd and get out the door. You're willing to take a lower dollar amount to go back to safety of basically almost 0% interest, but at least the money's not going to be dropping there. And that's kind of the mindset that people are having and have had for generations. So they're anticipating it. And in anticipating it, they've already raised the current yield on long-term bonds to our 10-year bonds to 1.9%. Was down under 1% at one point in time. So it's almost doubled. And that's the anticipation that they're going to continue to raise interest rates. Now, again, if that is true, I would be looking, we've been talking for a long time about fixed indexed annuities, and for the longest time I just didn't like the product. I didn't like the product because I thought you weren't going to make enough money, and I really don't like the way that most of them are being sold. That's what I really don't like about them, because it's a contract. It's a contract to give you a source of income. The income is not like a CD, and because you can pick an index that it's going to mirror minus some, they call it a spread. That's what the insurance companies make for managing the money and making the guarantees, but they're also buying options on those indexes instead of investing in them directly. It's a safer way to do it, but it's got a cost. All insurance has a cost. Okay. So you take the firm's management fees and you take the cost of that out of there, and the returns still better than CDs, but not like stock market returns. And a lot of people that are selling that stuff, you're going to get the stock market. No, you will not get the stock market returns, but the returns I think that they're willing to guarantee. This is the sole reason that I've been talking about this for the last few months. The guarantees on the income I like a lot better than traditional fixed income, particularly if you're going to buy, if you're going to buy junk bonds, or you're going to buy bonds that are 40 years or perpetual preferred stock, that have low ratings, there's a big risk to your principal there. Okay. Big risk to your principal. And those are the only places where you come close to matching the guaranteed interest rates that you can get through a fixed indexed annuity. I happen to like Nationwide. I like them a lot. If they have a website that you can go to, you can punch your information in there, your name, not your name, I'm sorry, your age, the amount of money that you're thinking of. You can actually do it one of two ways. You can put in how much money you think you might need, and I just did one just for the heck of it. But I'm not going to go to it right now. I think I'll wait till after our first commercial break, and then I'll go to it. But I'm going to somebody who's 66, and so it's going to be 67, going to be eligible for full Social Security in the next 6 months. Okay. So you're going to get full Social Security over the next 6 months. And they would like to have a certain amount of income guaranteed. And for this person, so it's a 66, they're going to be 67 soon. You can't take the income on this for a year. So let's say we're going to go out 1 year. And they've got a certain amount of income they would like to have guaranteed. It might even be, I got this idea from a couple of my clients. They called in and said, hey, how much would I have to put in to be able to pay for my health insurance? And when we come back from these commercial messages, we'll find out. This is Bill Bullington right here on 1420. Stay tuned. I'll be right back.
There's no ocean that can't be parted. There is no mountain that can't be moved. I know there's help for the heavy-hearted. The weak will find their strength renewed.
Been down the broken road now. I've been through that fire. There's angels holding on to both sides of the wire. I'm lagging what I need to carry you through it. Stay back or get on track, 'cause I can't have you ruin it. I say hold on, but don't hold me back. Hold on, but don't hold me back. Hold on, but don't hold me back. You just hold on.
And we're back. Not sure where that song came from. Not familiar with that one. Anyway, so listen, if you'd like to call 216-901-0945, 216-901-0945, and this is Bill Bullington. I'm here every Saturday morning. You can reach me at my website, by the way. It's bullingtoncapital.com. There's a little contact us page there. That's pretty easy. Or you can just email me, bill@bullingtoncapital.com, or you can just call us, 330-664-0700. So if you hear something that you'd like more information on, by all means, feel free. The last portion of today's show, I'm actually going to talk about one of the models that we use. And this is one of the things that we do that's a little different than traditional registered investment advisory firms do. For a long time, I managed individual stock portfolios. The biggest reason I don't do it anymore is it's really fast. I mean, super fast. And it's just really difficult if you're not if you don't have your hands on on a buy or sell switch, it's almost impossible. So that's the bad news. The good news is that they have created products out there. So if you've had that experience of managing portfolios on your own, you probably have a much better idea of what goes on behind the scenes. And it's a lot easier to identify those funds that have the right character or the characteristics that you're looking for. And believe me, I've got a couple funds in there I've been trying to beat, and sometimes I do, sometimes I don't. I look at the average annual returns in the long run, and they're pretty much the same. So I'm thinking, why am I killing myself? No, actually, I do it because I like it, and so you got that you've got that going for you. It can be pretty fun, okay? And figuring out how much income you're going to get, you should be able to get in retirement, can be pretty fun. It's pretty difficult depending on who you're talking to, but the changes keep coming. Now they're saying, remember, I've been talking about the 4% rule forever, and 4%, that's the amount that you should start to take out. That's what you should shoot for the first year that you go into retirement. I'm only going to take 4% of the savings that I have saved up for retirement that year. Why only 4%? Well, because you're going to have to raise that for inflation each year. You have to raise that for inflation. And that was for the longest time, it, was kind of the gold standard. Try to shoot for the 4%. So if you wanted $40,000 on top of your pensions and Social Security, you needed $1 million. So $1 million is, 4% of $1 million is $40,000. Why so low? Well, because again, you're going to raise that over time. Average retirement is over 20 years. And at current inflation rates, prices will easily double during that time period. So that's why you started out at 4%. Now they're starting to say 3.3. I haven't seen BlackRock, and Fidelity hasn't said anything about it yet so far. So those are the two top asset management firms in the world. And I think you're going to need to have better than just index type return on the portion of the money that you have in stocks. And for the bond side, you have stocks, bonds, and cash. Those are your basically three biggest categories. The other category is real assets like gold and real estate. Those are relatively small amounts. Is that the A+ thing? I guess if you're in an institution, you can get better deals than are available to the general public in most cases. Then, that would be something that I would add. If you can't get the kind of deals that it takes a lot of money to get into, I wouldn't pay a ton of attention to those two categories. And that's just my personal opinion. I'd spend more time on focusing on things like, okay, which industries are growing the fastest? And can I get exposure to them without taking on too much risk? How do I get exposure to say, we've been talking for the past 3-4 years about the healthcare and the semiconductor. Now, a lot of people are upset with healthcare. It's taken a breather over the last, 12 to 18 months. There's still stocks, folks. That's what they do. Look at the S&P 500's breather. It was 10 years. That was a 10-year breather with 250% drops in it. Okay, so all in it, no stocks go straight up, and I think that's really difficult for a lot of people who are relatively new to markets to have to deal with. Whatever your balance is, it's going to change day over day. Sometimes it's going to change a lot, and you really have to focus out over the next 10 years, and especially with interest rates as low as they are now. Remember, I was just talking about, okay, somebody that's 66, they're going to start taking income at 67, and they want to know, if I put $100,000 in there now, how much would that be? And by the way, you can hit me up on my website or just leave a message. I'll send you a link to this page so that you can play around with it. But if you're starting the income at age 67, you start with $100,000. It was in there for a year. Your guaranteed lifetime income is going to be $6,000 on $100,000. If you were getting 1.9% on a 10-year treasury, that's $1,900. This is not a treasury, and actually, I'm chiding myself for making this comparison, but I know a lot of people who are looking for income are thinking this way. It's not the same thing as a bond, though, folks. I have to tell you that. When you enter into one of these contracts, the money's being invested in an index. The way that they do it is pretty conservative, but if you had to pull it out, you may suffer a loss. And so you want to, this is kind of money that you want to be sure that you can leave there, and you're going to use it to supplement your income. That's kind of a big deal. Or, you don't have the income rider on there, because that's a rider. A rider is an insurance policy that you attach to life insurance or annuities. Anyway, if you didn't have that income rider and you just wanted something that was conservative but had a chance to grow, you could do that. I'm going to leave this money to beneficiaries. You could absolutely do that. So is it going to grow a lot? Probably not, because it's invested pretty conservatively. When you're buying options on an index, that's not the same thing as owning the index. The index goes down 50%, you're down 50%. The index goes out in 50%, and all you have are options on it. You just are out the options money, and that's it. So that's it's a big, huge difference. I feel so bad because this stuff seems so complicated, and it is complicated. It took me a long time to get my arms around this. But the bottom line is these are more conservative, and they give you options for income. If I go back to that person who's 66, going to start taking income out next year at 67, put in $100,000, they're going to guarantee him $6,000. If they got to age 67 and said, you know what, I'm getting by just fine without that. I don't really need to take that income right now. Well, great. If you don't take it for another year, it goes up to $6,509. So there's an extra $500 there. If you do it another year, it goes to $7,000. In fact, this particular contract guarantees a 10% increase in that income value for the next 10 years. So the $6,000 could actually, if you go out the full 10 years, will be $12,000. That's pretty cool. There's no other fixed income type of product that actually does this. These are the only categories. And by the way, there are thousands of them across the entire country. But this is very unique. And I think it's unique, very helpful that this is coming out at this time. When you got interest rates that are so low, when interest rates go up, bond prices have a tendency to drop. They do. In fact, let me pull up the Vanguard total bond market. They have an ETF now that does that, and it's been around for a really long time. So if I go just to this year, just to January, let's see, what is it down by? It's down about 7%. Okay, and that's an index bond fund. It's down 7%. If we looked at where it peaked, that was back in August of 2020, it's down about 8.5%. Now you're getting the income from that, and I believe the yield, the current yield on it is around 3% or so. So if you were reinvesting the whole thing, you wouldn't have nearly the loss of 8.5%. Okay. But those are, that's the bond index. That's incredibly difficult for most bond funds to beat. The vast majority of them will not beat it. And it's down 8.5%. That's a little spooky. That's why the financial aid, the College for Financial Planning is coming around saying, we might better rethink the 4% rule. Maybe because if you have 40% of your assets invested in something that's losing money, okay, that's a whole nother animal. And so they're cutting that number under 4%. So that is very timely for looking at these options, these other options like the fixed indexed products. They are fixed. They're not going to get an inflation bump. Well, probably not. I mean, there is a chance because they are buying the options on the underlying indexes. There's a chance that would actually grow faster than the amount that they're guaranteeing. It's not a good one. There's a chance I could probably run a sub 4-minute mile. It's not a good one. When I was in 8th grade, I ran a 58-second 440-yard dash. Okay, I couldn't do that again if my life depended on it. And I could never do it 4 times in a row. That was just not happening. So, but there was a chance. And that's kind of what the chance is of, that sort of thing happening. So, in the realm of all possibilities, all things are possible, but there are an awful lot of them that are not very probable. So you got to be, you just have to be careful. And I'm so glad that these products are here. See, the problem with us as people is we have a tendency to pass away. We die. Okay. So, and the older you get, the more likely it is that you're getting closer to that day. And so if the market were down, let's say the market could average 9-10% a year for the last 40 years, but during your 10-year time period, it could have been flat or negative. It happens. If your luck was bad, that would be really bad for your retirement income. Companies, the money management firms, they're not going away. Their life expectancy is way longer than ours is, because when some of the people that work there get too old, they retire and they're replaced by newer people or by younger people. Okay, so they don't have that problem with life expectancy. They can kind of hang in there and try to get their money back, and that's the whole idea behind a pension, actually. We're going to have people paying into it. We're going to have some people that have already paid into it, have saved up, invested the money. We're going to pay them out. And there are these people called actuaries that figure out how much they feel like they can pay out. And these are kind of like personal pensions that you can buy. They're contracts, they're binding to the insurance companies. There's a lot of really good stuff to these. And now they're starting to make them available inside of company retirement plans, which is, I think, fine. Mainly because the bottom line is it's kind of simple. When you see the 10-year example that I used, somebody who is going to start Social Security next year, they're 66, getting ready to retire. Next year they can take out $6,000 for the $100,000 that they put in a year prior to that. That's pretty good, and they're going to guarantee that for the rest of your life. One of the reasons you don't want to do this with 100% of your, I don't know, actually, if you're in your mid-70s or early 70s, then you could do a higher percentage. But if you're in your mid-60s, you might want to limit that to 50-60% of your total or so. And some people don't use it at all, which is fine too. If you've got enough money to be able to ride the wave, that's the problem with an awful lot of people is, they need to be very careful, because if you get a big decline in your stock funds and you're mostly in stock, or let's say you're 60% in stock funds, and it takes a long time for that money to come back, and if you live too long, you basically outlive your money. So it's tough. That environment, the investment environment, is very difficult, especially for people who are at or nearing retirement. We're going to need to take out more than 3% or so, 3 to 4% of their assets. There's going to be some risk involved, and this helps alleviate some of that risk. Okay, so that's why I keep talking about this. I get people calling me or emailing me, "Why are you talking so much about annuities?" Because it's a very important part of most people's portfolios. The latter section, when I come back from commercial messages, I will we'll talk about individual stocks if Bob the tax guy doesn't call in. Yeah, hey Bob. We'll get him on next week if he doesn't show up this week. No big deal. But we can talk about individual stocks, and yeah, it can be fun, can be exciting. You get to see what happens when companies' sales start to slow down. That's kind of wild. You get some pretty big drops in there in the prices. It's very quickly, and I don't know if anybody's been watching Facebook over the past few days, but it's pretty interesting. The thing about stocks, you can't really predict with a high degree of accuracy over short time periods. In short time periods, it's anything less than 5 years. That's not what you want to hear. I know you'd rather hear the kind of stuff that goes on in a lot of the advertising on the internet, the one stock portfolio and that kind of stuff. And yeah, that's not good. You really need to take a look at what you're doing. You need to take a look at, actually, we're going to have to take a look at this after these commercial messages. This is Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420. I'll be back right after these messages.
Lonely eyes looking back at me. Will we leave behind the innocent to grieve? On their run, when their lives have only begun.
And we're back. Hey, you're listening to Bill Bullington. I am here every Saturday morning from 11 to noon. If you have a question, feel free to hit me up on my website. It's bullingtoncapital.com. You can also call us 330-664-0700. That number again, 330-664-0700. And I'll be glad to try to help you any way I can. And I've got to take a phone call right now. If you'd like to call in, the number is 216-901-0945. And I'm going to go to Walter. Walter, you're on the Bullington Capital Report.
Bill.
Hey.
I want to talk about a couple of sectors that I think have been overlooked as far as the demand for what they do.
Right.
One is because of COVID-19 and, the pandemic.
Right.
I just bought a stock not too long ago in that field, but biopharmaceutical manufacturers, in other words, drug manufacturers, not the drug companies actually, but the the people that actually manufacture. A lot of that drug stuff is outsourced.
Yep. So
and because of COVID-19, we hear so much about the semiconductor shortage.
Yes. Well,
there's an actual drug shortage.
Yes.
As far as manufacturing facilities producing drugs that need to be, made.
Yep. That's one of the reasons that the healthcare sector model that I built that I can add to people's accounts. It's always a discussion whenever I talk to them. By the way, all those companies are in one of the major Russell indexes, and I hold all three of the, large cap, mid cap, and small cap. So we have that, and they have been very helpful in a model. And if you want, hit me up on my email. I'll send you a copy of this. So to be able to pick it, this model is run by Fidelity portfolio managers, and they go in and kick the tires. They do the kind of stuff that you just talked about. They looked at, these companies whose sales are rising and are going to continue to rise because this pandemic has really given them a boost. And they try to pick stocks based on that. Now, they hold them in different areas, and there are three funds that make up that one model. But I think you're right. I think you're absolutely right. We've been investing in it now for, probably 18, maybe 24 months. And it hasn't done that well, by the way. It hasn't done nearly as well as the semiconductors. But I don't really care because that's how stocks go. Stock market years are kind of like dog years in reverse. One dog year is 7 years in a human. Well, it takes about 7 years in the stock market to make the progress that humans think they should make in a year. And sometimes, but
yeah, right.
Yeah. So
another area I was reading Warren Buffett's annual report from last year.
Yeah.
And he points out, they own a bunch of energy companies, that supply to utilities and some Mid America Energy, I think it is, and others.
Right.
And he said that with those companies, that he's been told by the people that run them that the switch to alternative, energy, solar, wind, is going to take time.
Yes.
And one of the areas that, it's simple too, that they need more of is transmission lines.
Right.
And electrical cables and all that stuff. And he was told by the head of America Energy that they're not going to have that complete till 2030 because this is a sound reason. Because the solar panel places and the turbines, wind turbines, they're usually built out far away from central locations.
Right.
And because of that, you just need thousands and thousands of miles of electrical cable and transmission wires.
Exactly.
That used to be done pretty close to a city with a coal burning place,
Right.
Because the demand for that wire is so great right now, and it's not going to be completed maybe until 2030.
Right. Yeah, no, absolutely. And by the way, Mid-American Energy's one of the largest solar panel owners. They've got more solar panel farms than just about anybody in the country. So they've been kind of on that bandwagon. Yeah, that's what I've been talking about for a while too. This stuff is not going to happen overnight. You're basically talking about not only rebuilding the grid, but restructuring how they do business, because they used to produce their own electricity, the vast majority of it. Now they're going to go from being able to buy and sell kind of like a broker, but somebody still has to have the transmission lines there and all the infrastructure that gets the electricity from where it's being generated to where it's being consumed. And I haven't heard anybody talking about that except for, I'm going to have to go back and read that annual report. I didn't read that one, by the way, on Warren Buffett, because it's the same thing I've been thinking myself, sitting here, watching, listening, reading what's happening. You know, the grid. I had a client once. I met him at a I don't even know what they call them, but it's a junction box, I guess. It's where they were going to be taking the energy down, making it less powerful to go through the regular lines, electric lines. And it was on Madison Avenue up near Lakewood. And we went in it, we opened it up, and he showed me the age of that unit. There was a big metal plate with the date that had been installed on it, and it was 1890. Now, this was about 20 years ago. In 1890, I was like, you're kidding. He goes, no, it's because it's still very effective. And the costs to try to take this out, you know, in an established city with streets and sewers and all that, would have been much more than just leaving this equipment here and continuing to use it. So I'm going, wow, that is that was over 20 years ago. So that's what got me thinking that, wow, they're going to have to do this like all over the place. One of the reasons that some of the emerging markets are moving so much faster than we are is they don't have all that old infrastructure that they have to get rid of. So it's going to be very, very expensive. It's going to employ an enormous number of people. And like, you know, life is just constant change. That's basically how it works.
And there's $73 billion in that Biden's infrastructure plan that just goes to modernizing the electrical grid.
Yeah, they'll probably need a lot more than that. It's like a lot more. That's the starting point, and it's a good thing, by the way, because all that stuff, even if we bought every piece of equipment that we use from China, it's got to be installed and maintained right here. And there's no good way for them to get over here to do that. So it builds up U.S. jobs and puts very high-paying jobs out there, makes them available, and it's a good thing. You know, this is a really good thing, and we've got way more work to do that's feasible. That's actually going to provide huge benefits to the economy for generations, and then we have the capacity to do right now. That's actually one of the bigger problems. We don't have enough workers with the training to do this, even if we had all the money and the equipment. So, yeah, it's going to be a long time, but it will be a big boost to the U.S. economy. So,
I believe so.
Yeah. Well, hey, thanks for calling. I got another call. I got to hop here.
Okay.
Hope you have a good weekend.
You too.
Thank you. And actually, let's see. Oh, that's somebody calling in for a different show. Oh, that's hilarious. Sorry about that. So anyway, yeah, that's one of the things that you can really kind of relax on. I mean, there are always a million reasons that things are going to go south and not go good. There are also an awful lot of reasons that things are going to do well and even improve. And just think about this for a second. Think about your lifestyle. How do you live today versus how you lived 20 years ago? How do you live today versus how you lived 20 years ago? And if you go back and you look, go to Google, go use the Wayback Machine, and look at lifestyles from 20 years ago. I'm sure I don't even remember a lot of this stuff, But when I think about how much simpler an awful lot of things have become, we get upset today because our phones don't work. Something happened to something on the network somewhere. That happened to me on Friday. And people were having a hard time getting through. Well, 20 years ago, you should have seen what I had to go through then. When I first started using a cell phone, this is going back a lot more than 20 years ago, but that was amazing how crappy those phones were and what little they did. And we were really happy. We were happy to be able to have a conversation. Didn't have to pull over to a hotel somewhere and go in there. They used to have these booths there for traveling salesmen. They could go in and make calls between their sales. And I was just thinking about how that is so foreign today. Nobody would even know what those are if they walked into a hotel and saw that. It was kind of funny. But nothing is as constant as change. The speed of change changes as well. Sometimes you get a lot of change in a relatively short time period, and sometimes the changes take a lot longer. And that's the really hard part about projecting, what a company is going to do. An individual company. I see it all the time. That's why you want to spread that out, diversify it. You can concentrate in those areas like healthcare, semiconductors, if you'd like to, without pinning it all on one or two stocks. And I think that makes a lot of sense. Anyway, I hear the music. That means my show is over. Have a good weekend, everybody. This is Bill Bullington here every Saturday morning from 11 to noon on 1420. Have a good week, good investing, and good luck.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420. The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.